On today's Hot Sheet, I'm discussing the Fannie Mae Home Purchase Sentiment Index, tightened lending standards for residential mortgages, and weekly unemployment. Today is Thursday, February the 8th, 2024. I am Byron Lazine, and the Hot Sheet starts now. Thank you, first off, for the thousands of you that tuned in to the BAM Pro Bowl yesterday. And if you missed it, you still have an opportunity to go catch it. It's going to be uploaded later today for all of our BAM X members. Thank you. Bob saying still hungover from the Pro Bowl. Bob, we didn't say you were supposed to drink during the BAM Pro Bowl. That is on you. But thank you for attending, and thank you for so many of you for your kind words about the BAM Pro Bowl production, our first ever virtual Pro Bowl. And as Ryan Serhant said yesterday, you now own this day, BAM. So we'll continue that and make it an annual thing. So thank you guys for attending. If you want the replay, it'll be uploaded into BAMX later today. And for the next 24 hours, code PRO to get 30% off of BAMX. Do that on the annual. Is going to be good here for another 24 hours. So if you want that replay, it'll be uploaded for life into BAMX, of course. Use code PRO to get 30% off of that. Brock, the commercials were incredible. I don't think anybody's ever done that, a Super Bowl-like commercial on a virtual real estate event. So love seeing your comments here on the feedback from it. And I've gotten a bunch of DMs from so many of you, and it's been awesome. So thank you guys so much. It was all possible because of you and because of, I think, a little part to do with the culture we have here on the Hot Sheet. So many of the Hot Sheet people, all of you guys understand, hey, we need to better the industry. We need to raise the bar. That's why we do this every single morning. And you are sharing the love with so many other agents that can help improve. So thank you guys for that. And let's get into today's Hot Sheet. Fannie Mae just released data. Their HPSI is now at the highest level since March 2022. Their HPSI is consumer sentiment. It has now risen 3.5 points in January to 70.7. Again, the highest level of consumer sentiment we've seen since March of 2022. Interestingly enough, March of 2022 had an interest rate of about 4.2. There's March 8th. Let's get to March 21st. I think March 22nd might have been a weekend because it doesn't give me a March 22nd as a date. It does give me March 23rd, so maybe I just can't get there. Anyways, March 22nd was 4.66% on the 30-year fixed rate. That's close enough. March 23 was 4.68 on the daily survey. So 4.66, 4.68 during that time frame when we last saw consumer sentiment this high. This is the highest level since then. Yet we know that yesterday the 30-year fixed rate was at 6.95. So a full 2 percentage points higher on the 30-year fixed rate, yet consumer sentiment is the highest since that time. Okay, so this really it's for a couple of reasons. There's consumer confidence right now in job security. People feel very comfortable that they're going to have a job moving forward, that they're secure in their current position, that if their current position were to falter for some reason, that there are other opportunities in this job market out there for them. So the consumer's not worried about the next paycheck. They have security in that. Another significant jump in the share of consumers is that they expect the mortgage rates to decrease. Yesterday at the BAM Pro Bowl, we heard from David Childers, the CEO of Keeping Current Matters. He shares that same expectation. Keeping Current Matters standpoint is that by the fourth quarter, we'll be in the fives for the 30-year fix at 5.8, with a slow decline progressing from now to the fourth quarter. That'd be a full percentage point off of the 30-year fix from where we sit today. I pushed David Childers a little bit on that during the Pro Bowl and saying, well, what's your advice on what should buyers do now? I'd be cautious. And I continue. I love David's stance. And he said it, you got to have an opinion on the markets. Why we share so much data on the hot sheet, so you can take this data, this macro data, relate it to your micro market and have an opinion, have a stance on the market. I love that he said that. My opinion is still be cautious about guaranteeing 5% rates at any point this year, and also be clear and articulate on what a 5 handle means. It doesn't mean 5.00. There's really, you can't find any analyst that suggests we're going to have a 5.00 interest rate at some point this year. When they say we're going to hit the fives, they're talking about 5.8, like keeping current matters, or 5.9. I've seen a lot touching into the fives, which is essentially for most potentially even 6%, depending on their personal financial situation. Okay, but consumers' expectation is that the 30-year fix is going to continue to go lower. My caution with that is, how soon is it going to get there? And are you going to be able to receive that lower 30-year fixed rate as a buyer in this spring market, when the majority of the inventory is going to hit, and at the beginning of the spring market when you're going to get a lower price than you will at the end of the spring market, when comps always go up almost each and every single spring market for the last 25 years. That's why I think buyers should be looking right now in this February season. They're probably going to get a better deal than they will at the end of the spring, despite that the interest rate's closer to 7 than maybe where it will be at that time. That's such an uncertainty. There's 25 years of data that prices go up in the spring. So you can almost state that with certainty, where you can't really state the 30-year fixed with certainty. But we need to acknowledge that our consumers believe this number's coming down, and it's why their optimism, their sentiment is at the highest level since March 2022. They're not concerned about losing their job, 82% over the next 12 months. That's up from 75% last month. So pretty big jump there on the jobs. All-time survey of 36 respondents, okay, expect that mortgage rates will go down. That's an all-time high since they started doing this survey. Consumers more optimistic today than ever before since 2010, when they started doing the survey, that mortgage rates will go down. Share of respondents that are expecting rates to go down in the next 12 months has hit this high at 36%. It's more than the respondents who believe that these rates will go up, and also more than the ones that believe it will stay the same. Some other interesting facts from the Fannie Mae. Here's the sentiment, highest level since March of 2022 at the 70.7. You can see there as rates went up, we dropped into the 60s on the sentiment. 93 was in 2020. That was the highest level we've seen since they started doing this report in 2010, 2011. Okay, buying conditions. 83% do believe it's a bad time to buy, while 17% believe it's a good time. So, and this is where I think the education comes in on really explaining how long you might have to wait for that 30-year fix to come down. All the analysts said that home prices were going to drop in 2023. That didn't happen. In fact, year over year, we've seen them go up over 5.5%. Some areas of the country were double digits in home price appreciation. So for those that continued to wait last year and paid another 12 months in rent, they prolonged their opportunity to own. They prolonged their opportunity to have that forced savings, to be in the class of 75 times more wealthy from an owner than a renter, because they were maybe waiting for this rate. There's a lot of indicators that this spring home prices could go up. And if they do, by the end of the spring, you will have waited even longer to purchase a higher priced home than you could have just purchased today. So is it really a bad time to buy now? And how much more competition will these buyers receive when they get into a market where you have a lower interest rate? These are the conversations when you're doing a buyer consultation, when you're sitting down for a strategy session and articulating your value as a real estate professional with a buyer who's interested in hiring and contracting you for your services. Is it really a bad time to buy? Because there's an 83% chance that every buyer that you meet right now believes that it is. I would argue that you're going to have a lower price home today than you will by the end of May, certainly by when you see these closings that happen in July. June or July in almost every market is when the highest sales happen in any given month. That's a lagging indicator from properties that went under contract the end of spring, May. You can look this up on your MLS. I'd guarantee that over 90% of your MLSs will show that June or July in the last 25 months, take out the COVID months, it would have probably been August or September, showcase the highest sale price, lagging indicator from the end of spring as comps go up every single spring in any given market. You could take out a couple of funky resort markets or certainly those COVID months, but generally speaking, most markets in America see prices go up month over month in the spring, as that's when the most homes are available and the most competition comes to market. Selling conditions, 60% believe it's a good time, while 40% believe it's a bad time. I got to imagine the 40% believe it's a bad time based off of not being able to find their next home. That's the biggest struggle for sellers. We're at all-time prices, so if you're basing it off of the prices, it's certainly 100% would say it's the best time to sell because we're at all-time peak level pricing in this country, and you can move a property very quickly if you price it accordingly. There's low inventory. We're starved for, homes that have pride of ownership on the market for sure. We're starved for overall inventory. So 60% only being a good time to sell has got to be factoring in that, okay, that, the 40% bad time got to be factoring that it's hard for me to go buy a home on the other side. Home price outlook, 37% do believe prices go up over the next 12 months. 22% believe it'll go down. Mortgage rate outlook, again, the highest level at 36% ever recorded, believing the mortgages go down. This is your consumers' belief. Job loss concern. Nobody concerned really about that. There's 18% that are concerned. Very low number. That's what's driving this highest sentiment here for Fannie Mae since March 2022. Change in household income, 17% believe significantly higher, while 13% are significantly lower. Whole bunch of good charts in here. We'll load up to BAMX today. Respondents again say it's a good time to buy. We have that one in there as well as many others. You can pick through that and use that for some of your email newsletters, some of your communications with your database. Laura says showing clients the money instead of the percent difference can be super powerful. I completely agree. Showing them what it costs on a monthly payment too, as you wait till the end of the spring, it can really sink in for many homeowners. If the rate were to stay similar and there's, we're at a higher rate than we were at the beginning of the year right now. It's lower than where it was, in the fourth quarter average of last year. Yes. But as these buyers who are in the market right now, they're going week by week on this rate if they're not locked in. And that payment, if we're to stay the same today on the homes they're looking at, that would definitely be higher at the end of the spring as these prices will undoubtedly go up. Housing Wire reports that banks are tightening their lending standards for nearly all residential mortgages. This is according to a Fed survey. This is another data point that we're not going to get into a 2008 situation. I've been talking about this a lot on the hot sheet. This 2008, belief that's out there that, we're going to fall back into some type of mortgage crisis. It is 10 times harder to get a mortgage today than it was back then. We went through the charts yesterday, I believe, and even in the last couple, week and a half, we've gone through these charts that show how much higher of a credit score you need to have. And they're continuing to tighten those standards. That's been the case now over the last couple of years, really since 2012, in 2009, rather, it's been harder to get a mortgage, and it's continuing to get harder. There's also less capital. Okay. So while yes, homes are unaffordable at a very high rate right now, there are very few buyers that can qualify for these mortgages, which it's going to be the most qualified buyers that are obtaining these mortgages, which means the likelihood of them going into foreclosure is very low. And we see that foreclosure starts are at or near all-time low right now. The tightening lending standards across various categories of residential mortgage loans, bank tightening lending standards across real estate loans for residential in Q4 2023 due to high interest rates. So as the rates going up, they're tightening the standard in which you can get a loan. Survey results indicated significant tightening on non-QM jumbo loans and QM jumbo loans. Okay, non-QM is great for a lot of us. I just actually use the non-QM loan. Okay, non-QM would be where you don't have to basically show your tax returns; you show your bank statements. So somebody who's a business owner, a contractor, real estate professionals, non-QM loans are very powerful tool. And I think there's going to be more non-QM loans this year, 2024, than we've probably seen in recent memory. But those standards are tightening right now. Okay. They don't want it. The banks don't want to get into a situation anything like what's happened in the past. And they're going to continue to tighten those standards so that they don't get into that situation. Weak mortgage demand is noted here in the Housing Wire piece. Weak demand was reported across residential loan types, except for government and subprime mortgage loans. HELOC demand weakened notably, reflecting homeowners' hesitancy due to high interest rates despite increased home equity. There's also some data directly from that we'll have linked up here directly from Federal Reserve on the or from I'm sorry. What do we have here? Yeah, from the federalreserve.gov. We have their entire piece loaded up into BAMX on this 78-page document with some charts measuring supply and demand for commercial real estate, like commercial. Look at this. Look at the supply and demand curve here for commercial real estate loans. That demand obviously going down. Commercial real estate, it's going to be a scary thing for a lot of, if it's office building, for a lot of these banks to lend on. We've talked about that a bunch. Net percent of domestic respondents tightening standards for residential mortgage loans. You can see across the board, all residential mortgage loans, prime, non-traditional, subprime, government, QM, non-QM, all tightening those standards across the board here right now. So really important for real estate professionals to make sure that you're helping that buyer who wants to get into home ownership understand where they are going to sit in the financing process. Okay, what can they qualify for? And don't quit on them if they can't qualify today. There are a lot of people that just might need a rapid rescore or some other things, and you can help guide them as their professional to get to that point along with the lender. Okay, so a lot of conversations and education that is needed for would-be home buyers in this market. All right, just released this morning, we have new unemployment insurance data, and this is important for us to continue to monitor. Obviously, the sentiment is by most, as we saw there in the Fannie Mae housing sentiment, that people feel secure in their job. But if unemployments do tick up a little bit, not getting out of control, remember the Fed wants to, maximize employment while stabilizing prices. But the Fed also wouldn't mind unemployment going up a little bit. It'd make them feel more confident in their ability to fight inflation. Jerome Powell has said as much. I'm paraphrasing how he has put it. But that is something, their number one mandate's max or stabilize prices. Number 1A is maximize employment. They'll give up a little bit of employment for number one, stabilizing prices, if they can do so. So we want to monitor this very carefully because the stronger the job market becomes, the harder the job on the Fed to fight inflation can become in the future, and the markets can react. And we're looking for, obviously, these rates to come down. So what was the report here today? you had for the week ending February 3rd, the seasonally adjusted initial claims was 218,000 for unemployment. It was a decrease from 9,000 the previous week's revised level. The previous week's level was revised by 3,000 from 224 to 227,000. So that went up a tick. And now we're down a tick on unemployment claims. You can see here the weekly moving average here on seasonally adjusted initial claims. So unemployment continues to be low. Job market continues to be strong. The sentiment around that reflects both of that. And the strong job market report also is, I think, reflected here in the 10-year as we see that ticking up. Nobody's rooting for this to go up, but that's the case here today as we're at 4.144 on the 10-year. 30-year fixed again was in at 6.95 yesterday, down just from 6.96 the day before, significantly higher than that March 2022 number that we referenced earlier in the 4.2 range, which is the last time we've seen consumer sentiment this high. So despite that also tells us, hey, consumers are getting more comfortable with this rate. Okay. Thanks again for all of you that attended BAM Pro Bowl yesterday. If you missed it, it's going to be uploaded into BAM X later today, and you can get 30% off of BAM X for another 24 hours off our Pro Bowl giveaway. That is using code PRO, P-R-O. When you check out for the annual subscription of BAM X, use code PRO. Brings the price down on an annual from $228 to $160, a 30% savings. When you get into BAM X and you see all of the courses we upload every single month, all of the live streams that we do, the extra content that we upload, the show notes from every single hot sheet, including today's show notes. Every single day we upload the show notes and the daily downloads into BAM X. You are going to be like, what's the catch here? 160 for the year when you take the 30% off. 228 is your locked in grandfather rate when you go to resubscribe next year, whatever rate you got in. Some people got in lower before we raised prices. You will be locked into that rate. Take out the savings of the 30%. That's a one-time thing. And here's the show notes for today. Just substantial show notes. We had 4, and 13 charts. So that's 21 charts uploaded just today into BAM X. You get locked in grandfather rate. As we continue to add content every single month, BAM X prices will go up in the future. That is what Jerome Powell has taught me is called inflation. But you can get grandfathered in for life at your current rate, and you can get 30% off of this first year by using code PRO, and you'll get the replay of the Pro Bowl. Only place you can get the replay of the BAM Pro Bowl. Thank you to all of you who attended. Thank you for all of you who check out and share this hot sheet every single day. And I will be back with you tomorrow, back down in my Naples studio, and looking forward to doing so. 9:30 on the East, 6:30 on the West. Until then, of course, toodaloo, and have a great day.